AI will dominate lending underwriting, whether you're getting a credit card, a car loan, home loan, you name it, it's going to dominate who gets approved and who doesn't. I'm here with Matt Komos. Matt, how you doing?
Hey Phil, doing great. Thanks for having me back.
Good to see you.
Good to see you.
So, like this black box, this AI black box of underwriting, right? Computers deciding who gets approved and who doesn't. I mean,
Yeah,
like, let's open this up because it feels better when someone is actually checking the box.
yeah, and I think when we think about the history of underwriting and credit scoring, and in reality, it's kind of been a little bit of a black box for a lot of consumers all along. And back in the 40s and 50s, right, it was not uncommon that you'd have handshake deals, right? People, that's why the popularity of like branches existed because you could go in,
Yeah.
everybody kind of knew each other, and it was much easier to kind of get a loan. And it was almost more of a character underwriting, right? Like subjective. As lenders have grown, as population has grown, that just hasn't been feasible. So the reality is, computers, algorithms, those have been part of the credit underwriting ecosystem for decades at this point. But when we talk about AI, the reality is there's kind of simple forms of AI, which is called machine learning. Those have been done for years. Nowadays, we've got much more advanced techniques. So things like what they're called XGBoost and random forest, stuff that consumers generally aren't going to, unless you're a statistician or a data scientist, you don't understand what that means. But it's just much more sophisticated, and it looks for much deeper relationships. Now, what hasn't changed over this time is lenders are still required to be able to explain the decisions they're making and the models they're using. And so this is something the FCRA, the CFPB has been on top of, basically saying you can't use black box models, which in essence means I can't just create a decision or create a score and then not be able to tell a consumer why they scored the way they do. So if you've ever applied for credit, you get something called adverse action notice. And that explains kind of the top reasons why you might not have qualified. Regardless of how complex that algorithm is, that's still a requirement for lenders, So I understand though where many consumers kind of feel a little bit confused, or maybe they just don't understand kind of some of that decision making because they look at their credit report and say, well, these are things that I thought I was doing right, and then all of a sudden they're getting dinged. So I think the understanding and the complexity, on the consumer side hasn't fully caught up with where the technology is, and that's just the nature, I think, of innovation, unfortunately.
Now, Matt, let's start with the adverse action. Then I want to go to the approving process. The adverse actions, the problem with those adverse actions, some of them are so generic. It's
Very
like,
vague, they can be vague
like,
or
what does that even
generic.
mean? Like, you don't qualify for, income ratio. I mean, you're looking at it, you're like, well, wait, where? But they're not
Right.
required to give any more than what they gave. And it's almost like a checkbox. Here you go. I'm satisfied from legal requirement. Nothing more for me to do.
Yeah, and it is something like when I'm working with clients, I stress, let's give more detail
Yeah.
in our adverse action because of the fact, part of what you want to be able to do is help educate the consumer and give them, more information, right? But the reality is, there are specific guidelines that
Hmm.
have to kind of reach broad use cases. And so, FCRA requirements require adverse action. They do recommend to be as specific as possible. But to that point, when you're mapping to credit data, utilization rate is too high. Well, okay, what is
Hmm.
that on what?
Yeah.
And like, what should it be?
Yeah.
And that,
Right. That's the
so
thing.
that, right, that's sometimes the challenge because the requirement for adverse action isn't that you tell them necessarily what threshold they would have been accepted at,
Mm.
if they adjusted it, just that, well, you didn't meet our scoring criteria
Right.
because of these number of factors. The reality too is you're only required to return 4 factors, right? And so there could be more than that that's actually affecting the score, but the
Hmm.
consumer isn't totally seeing that because they're only getting 4 factors back. It's the top 4 that kind of affected the score. But for that given lender, even if like you hit those top four, the next four might not have been good,
Yeah.
so that's the challenge. And that's why, and then we've talked about this on a different episode, but that's why there's also like the educational component that many lenders and places like Credit Karma have tried to provide more education about
Mhm.
those moving parts in credit. But the reality is credit scores are pretty complex.
So our students are looking and they're rebuilding their credit, right?
Yeah,
And if we understand that AI, this black box is looking at things, there's probably a handful of things that our students can understand that they're looking at. Like we're talking broad strokes here, right?
sure,
And
sure.
one is obviously income, right?
Yeah.
I mean, income's a
Well,
big,
not in making a credit decision. So that is a distinction. So income is almost rarely or never used in the actual credit score or the actual will you get a loan or not. Income is typically used to determine how much you'll get or the credit line you'll get.
huh?
So
So wait, so that's interesting. So you're saying if if like if someone's making X number of dollars, I'm throwing numbers out,
yeah,
$100,000 versus 50, and they have the same exact credit score, the income's not just computed in that?
no. So what would typically happen is, let's say they both have a 800 credit score. So the person making 50,000 and the person making 100,000 would both get approved. The person making 50,000 might get a $2,500 credit line card. The person
Okay.
making 100,000 might get a $10,000 credit line card. So it
Okay.
helps determine, right? There's an
The
ability to
size of the
pay
limit.
component, the
Okay.
size of the limit or the size of the loan amount,
Right.
because ability to pay is a critical component, right? If you're making $50,000 a year, I don't necessarily want to give you a $25,000
No,
loan because,
definitely. Yeah, yeah.
right, that'll affect your ability to repay. That income piece usually comes in after the credit decision.
Okay. Okay, so great. So income's out. What are those broad strokes that this black box is really looking at from a credit perspective?
Yeah, so it's, very typically it's looking at the amount of total debt, what type of utilization you carry. So how high your balances on your revolving products are
Hmm.
relative to your credit line. So that's credit cards most often.
Okay.
It's looking at the mix of accounts you have. So do you have just all revolving accounts? Do you have some installment, which would be a
Yep.
car loan or a
Yep.
mortgage? The
Hmm.
length of credit history that you have, like how long have you been in the credit system, right? Which can be a challenge for some people that might have gone dormant for some years just because they didn't want to deal with credit. They had cash and they didn't want to deal with credit,
Or
but
they
now all of a
just filed
sudden,
bankruptcy,
or they
right?
filed bankruptcy. Yeah, I was just going to say, or
Yeah.
they filed bankruptcy and now, they're kind of coming into a different chapter of life where they might not have had that credit history. Payment performance is obviously very key, right? Delinquencies, how you pay your bills. Um, in some cases, like how much you're shopping for credit is
Hmm.
incorporated. I think we touched on this before, inquiries, right? So, but the reality is, if you're looking for a car or a mortgage, you might have a bunch of inquiries in a short amount of time because you're
Hmm.
shopping around. And so, what the bureaus have done is they actually deduplicate those inquiries, but that is a typical indicator of risk, right? So more inquiries is typically bad.
But they know if someone's applying for a car loan, any car lender that runs the credit report in the next, I think it's 45 days, counts as that one inquiry.
Yeah, it's just one, right?
Yeah.
Exactly. So it's
So
not dinging you a lot
yeah.
for yeah.
So let's go through this. Total debt, right? So total debt's going to give an opinion on credit risk. So with our students, we talk about with husband and wife separating credit. Like
Yeah,
don't apply for joint because this is an example of how what we teach. It's like, okay, great. You need something. You're gonna get this car loan, like the husband. Good. If you're carrying balances, transfer it to your wife for a month or two, get the car loan in the husband's name.
right.
That's a real life example of what you're talking with credit risk.
Practical application. Yep.
Practical application. Two, mix of accounts. Like the, with our students, we're talking about you have to have three revolving credit cards and at least one active installment line, right?
Yeah,
Because the banks want to see that you can handle a variety of
a
risk,
variety of
not
risk.
just one credit card that you pay off every month.
Right. And that's where, and lenders are going to look at that combination of total debt plus the mix of accounts, right? So
Yeah.
it's a different story if you have 100,000 in just installment debt
Yeah.
versus 100,000 in credit card debt, right? Installment debt could be a mortgage. You have a mortgage and a car loan, and so that risk is different than someone who might be carrying 100,000 in credit card debt, right? So
Completely different. I mean,
yeah,
you're always going to pay your car and your home
right,
before a credit card. That's what the lenders say, right?
yeah, right,
So that's why it's important to have a combination. You know,
yeah,
we talk about these deep credit roots, right? They're like a tree. You know, and if you don't have the deep roots, you're not going to be able to, you're not going to look favorably to the bureaus, right?
right. And as you're rebuilding, right there, it's not going to change overnight, right? So there's
Yeah.
some amount of patience that you have to have with that rebuilding process, you know.
Right.
Yeah.
And the nice thing about the rebuilding process, you know, we can go long about what's not good about the bureaus. The nice thing
Yes.
about the bureaus is that you can rebuild.
Yes.
I mean,
Right.
you can have 40 late payments on your credit report, a bankruptcy, and five foreclosures, and have a 720 credit score.
Right.
It's actually not that hard.
Right.
It's not that if you rebuild the right way, because the
If you rebuild
bank's
the
going to
right
look
way,
at
yeah.
this and say, what credit have you established after
After the
the
event,
breakdown? If there's the
whatever it
event,
was. Yeah.
that's the key.
Yep.
Okay, let's talk about the length of credit. So that's important because a lot of consumers they open these new credit cards constantly,
Right. Which
and
is
it just
bringing down your average history. Yeah.
it's just it's a naive way to build credit. You don't want that. You want the long lasting cards. It doesn't
Yes.
mean you're going to keep cards forever, like certain secured cards where you're the 79% APR. Okay, you're not going to keep that. You're going to keep that for 12, 24 months while you're rebuilding and
Right.
then hand it off accordingly.
But
But
to your
that,
point, you don't want to be opening a bunch simultaneously. You know, that's why the
yeah,
free cards that you use is a great recommendation, and build some history on those cards.
that's it.
And then as your score goes up, you qualify for better pricing, you know.
Yeah,
Yeah.
absolutely. Absolutely. And then, you know, the payments, beyond payment on time, you know, your payment reference. And I find this interesting because people are like, I don't understand why I have a low credit score. I've only been late 3 times. I'm like,
Yeah.
wait, what? Like you know, especially when you're rebuilding,
Yeah.
like, I've always found it odd that people would reference how to rebuild your credit and talk about on-time payments. Like, of course you have to be on time on your payment.
Right. Right.
Like, if you're even thinking about like not being on time, like game's over.
Games. Yeah.
Yeah.
But I think, you know, this is something we touched on in a different episode, but I think some folks, you know, you kind of learn how to deal with finances and credit from either parents or
Yeah.
peers, right?
Yeah.
And so for some people, paying on day 30 was a common practice. Like,
Yeah.
you know, there were never terrible consequences because they still made their payment, and it was just the way that they could manage their cash flow without sometimes realizing how much they were actually hurting their score, right?
Yeah.
And for a while, like again, going back years ago, that 30-day late payment, you walked it into the branch and said, sorry, I'm late. And it really didn't have like a
Right.
consequence, right? So if that kind of mindset might have been passed down to into the next generation, I think some people don't totally understand because they're viewing it as, well, I still made my payment, you
Yeah.
know, but it's late, right?
Yeah.
So yeah, it's definitely that educational component, breaking kind of prior habits and maybe, you know, things that people might have thought were okay, but in reality will be detrimental to your credit score.
Now let's touch on what you just said. So if a payment's due on the first, let's just say it's June 1st, right?
Yep,
It's not reported late till July 1st.
that's right.
Right. So even if after like 15 days or 10 days, whatever it is, depending on the credit card or the
They call
lender,
that the grace period. Yeah.
okay, they have a grace period, and then
Yeah.
there's a late period, late payment
Right. Yeah.
fee. So you can pay the payment and the late fee, and it's not reported late.
Right. Yeah. You can pay in the we call it the 1 to 29 day window.
Right. Yeah.
And if you pay it, you'll still get hit with a late fee and you'll make the payment, but you know, they won't report that.
So they're not going to report that. The bureaus have no idea on that.
No,
Right. And then it shows late the following month.
when you're 30
And
days
when
past
you're
due.
30
Yeah.
late, and that's when it's late.
Yeah, and that's where you'll see a real hit to your credit score.